Before anyone can invest successfully, they first need control over their money. Investing without a plan is like trying to build a house without a foundation. A budget gives your money direction. It tells every dollar where to go, instead of leaving you wondering where it went. One simple and effective budgeting method is the 50/30/20 rule. 50% of your income goes toward needs such as rent, food, and bills. 30% is for wants like hobbies, entertainment, and fun. The remaining 20% goes towards savings and investing. The exact percentages do not need to be perfect. What truly matters is consistency, not perfection. Saving effectively means setting aside a fixed amount of money on a regular basis. Even small amounts matter. Saving $5 or $10 consistently builds a habit, and that habit is often more important than the amount you start with. Tracking your spending helps you see where your money actually goes, which often surprises people. One of the most powerful tools you can use is automation. Automatic transfers from your bank remove emotion from decision-making. This builds discipline, helps money grow faster, and reduces the risk of investing at the wrong time. An emergency fund is another essential part of a strong financial foundation. This is money set aside for unexpected events. Without it, people are often forced to sell investments at bad times. Savings protect your investments by giving you stability when life becomes unpredictable. Just as important as strategy is mindset. Only invest money you do not need in the short term. Markets naturally move up and down, and this volatility is normal. Staying calm during these ups and downs, and avoiding hype or panic, is what separates long-term investors from short-term mistakes. Once your financial foundation is stable, the next step is learning how to evaluate investments. Stock prices alone do not tell the full story. What truly matters is value. The PS ratio, or price-to-sales ratio, shows how expensive a company is relative to its revenue. A lower PS ratio can suggest a cheaper stock, while a higher ratio may reflect strong expectations for future growth or signal higher risk. This ratio is especially useful when comparing companies that are not yet highly profitable, because it focuses on sales rather than earnings. While sales tell us how much money is coming in, profits tell us how much of that money the company actually keeps. This is where the PE ratio comes in. The PE ratio compares a company's stock price to its profits and shows how much investors are willing to pay for each dollar of earnings. Lower PE ratios may suggest undervaluation, while higher PE ratios often reflect optimism about future growth. However, price and profit alone do not tell the full story. It is also important to understand how efficiently a company uses the money it already has. This is measured by ROE, or return on equity. ROE shows how well management turns investor capital into profit. In general, a higher ROE indicates stronger performance and more effective use of shareholder money. Beyond valuation and efficiency, investors also need to understand how they are rewarded for owning a stock. Dividends are cash payments made directly to investors, usually from company profits. Some companies focus on reinvesting money to grow faster, while others prioritize steady income through dividends. Neither approach is better than the other. They simply serve different goals. This is why valuation is not about finding perfect numbers, but about understanding what you are paying for and why. To truly understand those numbers, you need context. This is where company reports become essential. Company reports are like report cards for businesses. Quarterly reports are released every 3 months, and annual reports come once a year. They explain how the company performed in the past and what management plans to do next.